And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith from Envision Financial Services. It's that time of the week once again, but something's different. You've brought company.
We have, yeah, special guest today. So we're going to touch on the potential changes proposed in relation to capital gains tax. And I thought, why not get in a tax specialist? So we've got Rhys from RSM with us today to sort of game theory what's been up there, what could happen, how could it affect people, should people panic, and really just give a sense of understanding that clarity is going to be important, execution is going to be important, and let's not dance at shadows. And that might be a good segue straight into, they've thrown up a proposal to get rid of the 50% discount in relation to capital gains. How do you see some of the challenges that they're going to face rolling this out?
Maybe we should go back to the start, Luke. I suppose, what are the capital gains tax rules now? I suppose the rules say that if you sell an asset for more than what you pay for it, then these capital gains tax rules apply to you. It's important to note that capital gains tax isn't a separate tax. It's a set of statutory rules to work out how much of that profit you include in your income. Simply speaking, if you're an individual or a trust, if you own it for more than 12 months, you only count 50% of that profit onto your income.
And that's important because that's the part of the change that they're trying to sort of administer now or amend as a way to either free up housing.
Well, you're opening up a huge can of worms here, Luke. Now, first of all, let me jump in and say we don't know what change they're going to make, if any. Yeah. But the one that's been most commonly proposed is reducing that discount from 50% down to maybe 33% or maybe 25%. And Luke, you're quite right. Yeah. The argument is somehow this is going to help free up housing and address that housing crisis issue. That's a separate argument again as to whether or not that's going to work, isn't it?
Absolutely. That's a supply issue, isn't it?
Yes, indeed it is. Indeed it is. But there's a number of different ways capital gains tax could be reformed, but assuming that's what they want to do by changing that discount, what would be the likely impact?
Well, go back a step. This Senate review or the inquiry that they're looking into is supposed to report their findings mid-March. Now, that isn't going to be a legislative change. That's going to be a report to the government. Now, any change isn't probably going to happen until the budget, which is in May.
Yep.
I suppose if you go back, the last piece of reform was about 2010 when the Henry Review took place. They didn't quite listen to all their input either.
No, that turned out to be a bit of a non-event because some of the more significant proposals were simply not adopted.
Yep.
So here we are once again. My question is, though, and I'm sure you've got a long memory, before we had this 50% discount, we had a thing called cost-based indexing, which basically took into account the rate of inflation for every year that you held the asset. Why can't we just go back to that? That's nice and simple.
Peter Costello changed it in 1999.
He did, that's right. But
it was fantastic.
Well, it's fantastic if you were the benefit of it.
Correct. But it was, the old rules were very simple. It said the longer you held an asset, the less tax you paid.
Yep.
He came in and said, hey, if you hold it for more than 12 months, you only count 50% of the profit.
Yep.
Fantastic. Mm-hmm. Nice and simple.
It is simple, but my argument is that the old way is actually not that difficult because even the Reserve Bank Board, the Reserve Bank of Australia, on their website's got a simple inflation calculator. You plug in the number in the year you bought the asset, the number that, the year that it is now, press calculate. It tells you what the change in value actually is.
Yep. But once you give someone something, it's hard to take it away.
That is true. This is going to be politically dynamite, isn't it?
Yep.
I think the other thing that we really need clarity about, and I guess we sort of stress to the listeners, is don't react to noise and misinformation or a lack of detail with what's been thrown up, because we've seen in the past, in 07 when they opened up that contribution window for super, that people raced out and sold properties and threw money into super on an individual piece of legislation. We don't know if this is going to be just on housing. We don't know if it's going to be on shares. We don't know if it's on all assets. We don't know if it's going to be an amendment to the CGT small business concession. So the application of this change could be far broader than people actually anticipate, but we have no detail.
If the Greens got their way, it would be abolished altogether. That's what they've said. They said just get rid of the discount altogether. That's their thing, and across the board on all asset classes. Now, I don't think that's the way the government's going to go. They're not that stupid, are they? Or you don't want to answer that, do you?
No, the only comment I'll say is that our phones have been ringing hot from clients wanting advice because they want to take action.
Yeah.
We've been giving them guidance that they need to be calm and they need to really carefully consider this and to not jump into things. We're hearing from others that they're being told to sell things, and I think until there's more clarity, caution.
Yeah, and I have to ask, if you're not planning to sell anytime soon anyway, why would you sell now? Is there any particular point to that? If you anticipate you're going to be selling in the next few years and you want to avoid the change of rules, that would make sense. But if you're not planning to sell anytime in the next few years, you just hold it and enjoy the returns on it, wouldn't you?
Correct. Well, you bought an investment to make money, haven't you?
Yes, that's the idea.
And when you make decisions based on tax, I often find you tend to make poor decisions.
Yeah.
I think the other important thing to consider here, whilst we have no detail, is then let's look at the implementation of a change. Let's say it went from 50 to 33%, 20%, a time-weighted number, whatever it may be. How do they then roll that out? Because that will have a direct impact on how people feel and react.
Yes.
Do they draw a line in the sand and say, from now on?
Yep.
Do they say, from 1 July 2027, from 1 July 2028, from last night at midnight? So it's one thing to understand the implications of the change. It's another thing to then consider the rollout and the execution of those changes, because that could lead to a change in behaviour of great significance, where people want to get rid of something before they lose the 50%, and then you've got your argument about housing, no housing, and that's another whole conversation. So I think people need to be mindful that there is no clarity. Somebody like Rhys is there to be a sounding board and give advice in relation to individual situations once we know what we're dealing with. But I think, as Rhys has just said, we'd caution people racing out and making assumptions and dancing at shadows, because the rules could be changed, but they may not be implemented for a significant period of time, which could give you a window to make informed decisions. And that's really what we want people to take from today is don't worry about the lads at what they're doing at golf. Worry about what the law says. Worry about what your accountant says. Worry about what your trusted advisor says, and work through what the implications could mean for you.
Okay, which really brings us back to where I started today. We don't know what the government is actually going to deliver. There has been a lot of chatter, and it would seem that the favoured option would be some sort of reduction in the capital gains tax discount, possibly focused only on property and possibly focused only on existing property, and allowing people investing in new builds to actually keep the full discount. These are all options on the table, and yet we don't know which one they're going to go with, do we?
And look, and I think that's it. I think the important thing to reiterate here is exactly that. We don't know. And what sort of manifestation of the changes do we get? Is that going to then affect CGT small business concessions? So you're now, if you sell your business, you can't use a 50% discount in that part of the legislation. So again, we'd preface caution, clarity, and as Rhys said, you buy an asset for growth, and whether it's a share, a property, commercial, resi, whatever it may be, you generally don't go and buy something with the tax planning first, because it's a bit like putting the wheels on the car.
The other thing that Peter Costello said all the way back then in 1999 was the reason for it was to encourage investment, particularly in the Australian equities market. And if for whatever reason the government decided to remove the discount from all asset classes, including shares, what sort of impact would that be likely to have on the investment market? Would people stop looking at shares as an attractive investment and try and find other opportunities elsewhere?
I think it's going to depend on how they roll it out. It's a really good question, because if they say, look, if anything any transaction that occurs between budget night and 30 June, you get the discount, there's going to be chaos.
Yes.
Everyone's going to be dumping and selling straight away. So I think, to me, it's going to be how they roll this out will determine what really happens. When I speak to people, they often talk about grandfathering, where they draw a line in the sand and they say any asset bought after this date, these are the new set of rules. You speak to some
Yeah, in the interest of fairness, that would be the preferred solution. If they want to make a change, it would only be fair to make sure there is a grandfathering provision so that you're not shifting the goalposts for people that are already halfway through the game.
I think that's the critical part is, again, the rollout, as Rhys has said. What does it actually look like, and how does it actually affect me, you, and anybody else that has an asset that this will determine some very critical decision making? Because, as I say, we might have to get a real estate agent on here next week, because if they roll it out from budget night to 30 June, house prices could go through the roof because people are going to be almost forced selling, because the tax implication on something you've owned for 15 or 20 years could be quite dire.
And I think the government will be cognizant of that, which is why they wouldn't sort of drop that on the market. I think they would be measured if they did anything. But I think equally, why they're talking about this is about making houses more affordable. And I don't think the CGT discount or adjusting that does anything for that. This is about revenue raising.
Yes.
If they wanted to really affect and bring about changing in housing affordability, I think you're potentially looking at things like changes to negative gearing, where perhaps you only offer that to new houses now. So you encourage activity of investors funding new purchases. So guess what? Builders are now being busy. We're encouraging activity in the market. To me, that's a much smarter way to do things.
There have been reports that negative gearing is also in the mix of discussions at the moment, despite the fact that they lost 2 elections over that and said we've learned our lesson and we're not going to do it. Well, apparently that is in the conversation, so there may be some version of that as well. But at the end of the day, as you say, it's a supply issue, and the only thing that a government can do about supply is actually spend more money on providing more supply through things like social and public housing, and they're just not delivering on that front.
The other thing they could do is look at their taxing. I mean, when we look at our clients that are developing properties in New South Wales, roughly 1/3 of the cost of that land is going to the government.
Oh, yes, definitely. And a lot of that is things like local government fees and charges, which
GST,
which have
tax.
Exploded over the last 2 or 3 decades. It's become so expensive to create a block of land for a house to be built on. I remember back in the day, the block of land was the cheap bit.
Yep.
And now it's not.
No, and I think there's your red tape scenario of you look at all of these things online about, well, you've spent this amount of money, what's been produced? We just can't get stuff out of the ground fast enough, no matter what they throw at it, no matter who administers it. It seems to be an ongoing debacle. And this isn't about something that's going to improve that, because we've seen absolutely no change with that type of conversation and the ability under any circumstance to provide more supply, because all we do is put more fuel onto the fire.
Yes.
And don't realise that that's actually part of the root problem as well.
Yeah.
We just try and look at the right-hand side of the transaction, or we don't have enough houses. Well, if we had less people trying to buy them, that's half the equation, which seems to be overlooked on a regular basis.
So, what are the key points to remember?
Well, look, I think, as we've said before the ad break, people need to sort of keep their head screwed on here. We don't have any definitive detail, and I think you could cause yourself a lot of potential harm financially by leaping to an assumption. I think people need to keep in mind that we don't know what it's going to apply to. We've spoken about potentially it having an impact on a housing market and the sale of a common investment property asset. But we don't know whether that's going to affect shares. Is there an exclusion for certain asset classes? Is it CGT small business? Like, where does it end up? I think from a planning perspective, what's your view in relation to that at work, mate?
From my point of view, it's exercise caution, review your numbers. I wouldn't jump into anything. My personal view is I think there's a lot of scaremongering out there with this. I think it's getting everyone worried. I think push comes to shove, I expect there will be a change last minute, and they'll probably target something else. We saw that when they were talking about removing the childcare rebate. Last minute they changed that, and then they means tested the Medicare levy or the 30% federal the insurance rebate.
Yeah. So again, I think
private health insurance rebate.
That's the important thing is until it's law. And this is the case with any budget. We propose X, and then until it gets raw assent and it's law, let's not worry about it too much. And we don't want to be dancing down the street and find out, well, there's no case to answer because that got removed, this got changed, that got backed out, and it looks like this. Because people need to keep in mind that everybody's situation is going to be different. And I think it just stresses the importance of getting advice prior to acquiring an asset.
Well, I've got two things to say. If you bought something because it's a good investment, it's still a good investment.
Great.
And the second thing is, of course, to pay capital gains tax, you first have to make a capital gain. So even if they increase the amount of tax they take, you're still coming out in front, just not by as much as you were. So Correct. It's not the end of the world.
Yep.
Exactly. And I think, Rhys said before the ad break, it's capital gains tax is effectively just income tax by another name.
Yeah.
Because people seem to have a clear distinction between the two, but ultimately just ends up in what's my adjusted taxable income. And then somebody like Rhys steps in and says, well, let's make a contribution. Let's roll that over. Let's pass that here. Let's carry forward this loss. And that, for me, is the important part of tax planning and having advice in that space so that you can make the most of your investments and then engage somebody like Rhys to drag you through the bush backwards and have a win against the ATO, which is ultimately all we ever want, right?
Indeed, yes. I mean, I'll put that on my Christmas list. Where can listeners get further information? First of all, Rhys, how do they get in touch with you?
Call us. Call our switchboard, book an appointment, 6217-0300.
Fantastic. And Luke, as always?
Yeah, 6260-4749. We've got Envision Financial on the internet. We've got the Strategy Stacker podcast, iTunes and Spotify. And we've got Envision Financial Canberra on YouTube, where you and I have a massive catalogue of
I should be getting
shows.
Royalties after all these years.
Well, if I get some, I'll give you some. And we've got Smart Money Strategy, your ultimate guide to financial planning in all good and bad bookstores.
Fantastic. And that brings us to the end of today's interlude. But Luke, you'll be back with us again next week.
Well, we might have a real estate agent.
Bring another special guest. We'll see how we go. Rhys, thanks very much for coming in today.
Cheers, bud.
Rhys Keepers from RSM and Luke Smith from Envision Financial. Luke will be back with us again next Friday afternoon at about the same time, between 4:30 and 5 o'clock.